Segregated Funds Exam Prep Example Questions. Question 1. Calculating net worth. The scenario: Amelia has the following assets and liabilities. House worth, $425,000 mortgage, $200,000 car worth, $20,000 car loan outstanding, $8,000 whole life insurance policy with a cash surrender value of $30,000. Policy face value is $500,000, RRSP money, $50,000 TFSA, $15,000 bank account balance, $3,000 line of credit. Balance owed, $10,000. Limit is $25,000. What is Amelia's net worth? The answer and rationale: Amelia's net worth is $325,000. Net worth is calculated as assets minus liabilities. The total assets of $543,000 are comprised of a house valued at $425,000, a car at $20,000, a cash surrender value of $30,000, an RRSP of $50,000, a TFSA of $15,000, and a bank account balance of $3,000. The total liabilities amount to $218,000, which is the sum of the $200,000 mortgage, the $8,000 car loan, and the $10,000 line of credit owed. Net worth calculation: $543,000, assets, minus $218,000, liabilities, equals $325,000. A net worth statement shows the amount of money a person would have on a pre-tax basis if they were to liquidate all their assets and pay off all their liabilities. Question 2. Segregated fund guarantees. The scenario: Robert is a long-haul truck driver with 20 years of experience who wants to invest his life savings for the long term. He's looking at segregated funds because he likes the creditor protection and the ability to designate specific beneficiaries, which helps bypass probate. He's familiar with market cycles and isn't worried about short-term fluctuations. His main concern is ensuring his family does not receive less than the amount he originally invested if he were to die unexpectedly. He is also cost-conscious. What type of segregated fund guarantees should be recommended for Robert? The answer and rationale: the recommended guarantee is a 100% death benefit guarantee and a 75% maturity guarantee. Robert is a long-term investor who is comfortable with market risk, so a 75% maturity guarantee is acceptable, as he's only risking 25%. However, his primary concern is ensuring his family receives every dollar he invested if he passes away. The only way to ensure this is with a 100% death benefit guarantee. It's important to remember that all segregated funds must have a minimum of a 75% death benefit and a 75% maturity guarantee. Robert's desire to ensure his original investment is returned to his family upon death means he needs to choose the option that maximizes that particular guarantee. Question 3. Group RRSP vesting. The scenario: Michael has a group RRSP at work where both he and his employer contribute 5% of his earnings. Michael is planning to quit his job and move to another employer. He wants to know if his group RRSP has vested, specifically regarding his ownership rights on the employer's contributions and any investment growth. The answer and rationale: in a group RRSP, all monies are vested immediately. Vested means ownership. Because the money is vested immediately, both the employer's contributions, e.g. 2.5%, and the employee's contributions, e.g. 2.5%, belong to Michael, and he can take all the money with him when he leaves. In contrast, other types of employer-sponsored plans like a defined contribution pension plan, DCPP, defined benefit pension plan, DBPP, or deferred profit sharing plan, DPSP, often have a vesting provision. For example, a maximum 2-year vesting period is common in Ontario, where the employee's contributions are vested immediately, but the employer's contributions only become vested after 2 years. If the employee leaves before that period, the employer's money stays in the pool. Question 4. Defined contribution pension plan options. The scenario: William has been working for his current employer for 12 years and has accumulated $60,000 in a defined contribution pension plan, DCPP. He recently accepted a job with a new employer who also has a DCPP. Since William has been with his current employer for 12 years, his money is vested. What is not an option available to William regarding the accumulated $60,000? The answer and rationale: the option that is not available to William is transfer the money to an RRSP. The key reason is that a company-sponsored pension plan, whether DCPP or DBPP, contains locked-in money. An RRSP is not locked in. You can cancel and withdraw the money anytime. Locked-in money generally cannot be transferred to an unlocked-in vehicle. Available options: leave the money with the current DCPP. Transfer the money to the new employer's DCPP. Transfer the money to a locked-in retirement account, LIRA. A LIRA is a locked-in vehicle designed to hold pension money. William cannot cash in the money right now as it is designed to provide a lifetime pension and must remain locked in. Question 5. Segregated fund top-up at maturity. The scenario: 10 years ago, Sarah invested $100,000 in a segregated fund with a 100% maturity guarantee and a 100% death benefit guarantee. When the fund matured, its value was only $90,000 due to market conditions. Sarah is optimistic and believes the market will normalize, so she decides to renew her contract for another 10 years. Is Sarah entitled to the guaranteed top-up renewal? The answer and rationale: yes, Sarah is entitled to the guaranteed top-up renewal. The insurer will deposit the top-up guarantee amount into her account. Since the actual fund value, $90,000, is less than the 100% guarantee, $100,000, the insurance company is obligated to top up the difference. Sarah will start her renewed contract with the original guaranteed amount of $100,000. If the fund value had been greater than the guarantee, e.g. $110,000, the guarantee would be considered zero, and the insurer would not have to top up anything, as the client already has more than the guaranteed amount. Question 6. Power of attorney and contract maturity. The scenario: John, the owner of a segregated fund contract, named his daughter Nancy as the main beneficiary. John's health has deteriorated, and he appointed his brother, Paul, as the power of attorney, POA, for financial affairs. The segregated fund contract matures tomorrow. Who can make the contract maturity claim? The answer and rationale: Paul, the power of attorney, POA. Since John's health has deteriorated, he is unable to make decisions on his own. Paul, as the POA for financial affairs, is now in control of the segregated fund contract. Despite Nancy being the named beneficiary, Paul can choose to cash in the fund and use the money for John's care, or whatever else is within his legal power. Question 7. Guaranteed minimum versus lifetime withdrawal benefits. The scenario: Brenda wants to know the difference between a guaranteed minimum withdrawal benefit, GMWB, and a guaranteed lifetime withdrawal benefit, GLWB. What is the fundamental difference between these two withdrawal benefits? The answer and rationale: the fundamental difference lies in the duration of the guaranteed payments. GMWB payments are guaranteed for a fixed period of time, a fixed number of years, like 20 years. This is similar to a term-certain annuity. Since the payments are only for a fixed period, the monthly payment amounts will be larger than a GLWB. GLWB payments are guaranteed for the rest of the annuitant's life, a lifetime. This is similar to a life annuity. Because the payments could go on for a longer period of time, the monthly payment amounts will be less than a GMWB. Question 8. Group plans for retired employees. The scenario: David runs a corporation with 60 employees that offers a defined contribution pension plan, DCPP. He wants to know if there are any group plans he can offer to his retired employees that will assure them they won't have to make complex decisions about their retirement savings accumulation on their own. What type of group plan should David suggest to help his retired employees manage their locked-in pension money? The answer and rationale: David should suggest offering a group life income fund, Group LIF. The money accumulated in a DCPP is locked in. Upon retirement, locked-in money must be transferred to a locked-in vehicle, such as a LIRA or a LIF. A LIF is an income-paying registered vehicle where the L stands for locked-in and life income. By offering a group LIF, the cost, e.g. management expense ratios, may be lower, and the returns may be better due to the larger pool of money, providing an advantage over individual LIFs. A group LIF allows the employer to continue helping their retired employees manage their locked-in funds in a collective, potentially more cost-effective manner. Question 9. Annuity protection against insurer insolvency. The scenario: Eleanor is planning to purchase a life annuity with a single insurer. Her $500,000 investment is estimated to provide a payout annuity of $3,000 per month for the rest of her life. She is concerned about what would happen to her annuity payments if the insurer were to go bankrupt. If the insurer becomes insolvent, how much is Eleanor guaranteed to receive per month? The answer and rationale: Eleanor is guaranteed to receive $2,550 per month. Products sold by an insurance company are consumer protected by a non-profit organization called Assuries. For monthly payments like an annuity, Assuries protects 85% of the covered benefit, no less than $2,000. Calculation: 85% of $3,000 equals $2,550. Since $2,550 is more than the $2,000 minimum guarantee, the benefit is the calculated 85% amount. Question 10. Risks of fixed income investments. The scenario: Olivia invests her money primarily in guaranteed investment certificates, GICs. She asks her financial advisor about the risks she faces with these investments. What are the two primary risks associated with fixed income securities like GICs? The answer and rationale: the two main risks with fixed income securities like GICs are interest rate risk and inflation risk. Interest rate risk: this is the risk that interest rates will change in the future. If Olivia locks in at 3% for 5 years and rates rise to 5% the next year, she misses out on the higher rate for the duration of her GIC. If she locks in at 5% and rates drop to 3% upon renewal, her income will decrease. Inflation risk. This is the risk that inflation will erode the purchasing power of her money. For example, $5,000 in 10 years may buy less than it does today. Since the interest rate is fixed, it may not keep pace with the rising cost of living. Risks not applicable. GICs and annuities are not market-driven. They do not carry market risk, industry risk, or credit risk because the principal is guaranteed by the institution or a government body. Question 11. RRSP segregated fund ownership. The scenario: Leo has accepted your recommendation to invest in a segregated fund held within an RRSP. Leo wants to know the rules regarding ownership and annuitants for this type of registered plan. What is the necessary requirement for an RRSP segregated fund contract? The answer and rationale: the necessary requirement is that the owner and the annuitant must be the same person. Registered plans like an RRSP are for single life only. There are no third-party registered plans. Leo cannot, for example, own an RRSP for his wife or his son. In contrast, a non-registered segregated fund or annuity can have a third-party annuitant. In a non-registered contract, the owner, Leo, could be different from the annuitant, his wife or son. Question 12. Determining investment objectives. The scenario: Maria is a new client whose portfolio you are reviewing. Her investments include GICs, government bonds, and registered and non-registered accounts. She lives within her means, has no outstanding debt, and is employed. However, she is not happy with her returns and is concerned about having a decent retirement. Based on her current investment choices, what has been Maria's primary investment objective until now? The answer and rationale: Maria's primary objective until now has been safety of principal. Her current holdings, GICs and government bonds, are considered very safe and conservative. This suggests that her main focus has been on minimizing risk and protecting the money she has, rather than achieving high returns. Growth is clearly not her objective, as her current portfolio is not growth-oriented. Income generation is also not being met to her satisfaction, as she is unhappy with her returns. Tax-advantaged is not a primary objective, as she has non-registered GICs, where taxes are paid on interest annually. Maria's issue is that her extremely conservative approach, very low risk tolerance, has led to low returns, which is now jeopardizing her retirement goals. Question 13. Group segregated fund versus individual segregated fund. The scenario: Jordan wants to invest in a group RRSP offered by his employer, with segregated funds as the underlying security. Which of the following requirements that an individual segregated fund offers will not be met by investing in a group segregated fund? The answer and rationale: the requirement that will not be met is a maturity guarantee. Group segregated funds, as the underlying security in a group RRSP, do not offer a maturity guarantee or a death benefit guarantee. This means that when the contract ends or a death occurs, the payout is simply the market value, which is what the market will bear. Advantages of group segregated funds: the trade-off for losing the guarantees is that group plans typically offer no sales charge, lower management expense ratio, MER, no switching fees when moving between funds. Question 14. Annuity choice for maximum income. The scenario: Mark is retiring soon at age 65 and is a member of a DCPP. He has decided to purchase an annuity as his pension vehicle. His children are financially secure, so he doesn't need to leave them an inheritance. He estimates his and his wife's life expectancy to be about 20 years. Which annuity will give Mark the highest monthly income while meeting his life expectancy and other requirements? The answer and rationale: the best choice for maximum income is a joint last survivor life annuity with 60% at second death and no guarantee period. Mark wants the highest possible income while he and his wife are alive. A joint last survivor life annuity ensures that income continues for as long as either he or his wife is alive. The 60% at second death means the income will drop to 60% of the original amount upon the death of the first spouse, e.g., $5,000 drops to $3,000. This reduction allows for a higher monthly payment while both are alive compared to a 100% benefit. No guaranteed period, such as a 20-year term, also makes the annuity less expensive and thus increases the monthly payout, as the insurer takes on less risk of having to pay a beneficiary. Question 15. Joint last survivor annuity claim. The scenario: George was receiving a monthly payment from a joint last survivor life annuity with a 20-year guarantee period. His wife, Helen, is the joint annuitant, and their son, Paul, is the beneficiary. George died 8 years after purchasing the annuity. Who can submit a claim to the insurance company regarding George's annuity? The answer and rationale: Helen, the joint annuitant and surviving spouse. Because it is a joint last survivor annuity, the payments continue to the surviving spouse, Helen, after the first spouse, George, dies. Helen is the one who will receive the continuing payments. The son, Paul, as the beneficiary, would only receive payments if both George and Helen died within the 20-year guarantee period. Since Helen is still alive, she remains the recipient of the income. Question 16. Guaranteed minimum withdrawal benefit versus systematic withdrawal plan. The scenario: Frank owns a mutual fund investment of $200,000 and plans to set up a systematic withdrawal plan, SWP, of 5% per year. His wife, Anna, owns a segregated fund with a guaranteed minimum withdrawal rider, GMWB, which guarantees a withdrawal of 5% of $200,000 for 20 years. Frank wants to know the advantage of Anna's GMWB over his SWP. The answer and rationale: the main advantage is, Anna is guaranteed a minimum payment of $10,000 for 20 years, provided she does not make any excess withdrawals. The GMWB advantage: a GMWB is a guarantee. Even if the market crashes and the fund value drops significantly or tanks, the insurance company guarantees the minimum annual payment for the fixed term, 20 years. Taking an excess withdrawal can void or alter the guarantee, potentially causing the money to run out sooner or the guaranteed amount to be recalculated downwards. The SWP limitation: a systematic withdrawal plan has no guarantee. The payments are drawn directly from the fund's value. If the market tanks, the withdrawal plan can be shot to pieces, and the fund could run out of money prematurely. The payment amount is also subject to the market conditions. Question 17. Short-term investment objective. The scenario: Sean is saving for a down payment on his first home. He is contributing to an RRSP and a non-registered account, and he plans to use the Home Buyer's Plan, HBP, withdrawal from his RRSP. He is focused on having a reasonable down payment by a fixed, relatively near future date, a short space of time. Given his objective, what should be the most important factor for his investments to fund the down payment? The answer and rationale: the most important factor is safety of principal. Because Sean has a very specific and fixed short-term objective, the down payment, he must prioritize protecting the capital he's saving. Growth is too risky for a short-term goal, as the market could decrease substantially by the time he needs the money. Income generation is not his focus, as he's saving, not needing. Current income. Tax savings is secondary to his main goal of having the required cash at the appropriate time. Question 18. Impact of excess withdrawal on GLWB. The scenario: Laura has a guaranteed lifetime withdrawal benefit, GLWB, plan that guarantees her an amount of $1,500 per month for the rest of her life. Due to an unexpected event, Laura now needs to withdraw more than the $1,500 per month she is already receiving. Which of the following statements is true about the consequences of her excess withdrawal? The answer and rationale: the true statement is, Laura can withdraw an additional amount from the GLWB plan, but the guaranteed lifetime payments will be lowered as a result of the withdrawal. When Laura takes out more money than the guaranteed amount, she alters the plan. She is reducing the amount of money sitting in the pot, which means the insurance company will have to recalculate and adjust the guaranteed payment amount downwards, e.g., from $1,500 to $1,200, to ensure that the money lasts for her lifetime. A GLWB is not locked in, so she can withdraw the money anytime she wants. The withdrawal is not contingent on market performance. The guarantee cannot remain the same if she removes extra money, as the fund needs to be readjusted to sustain payments for her life. Question 19. Life annuity application requirements. The scenario: Peter is a 70-year-old widower who wants to use his RRSP money to purchase a life annuity contract with a 20-year guarantee period. He wants the payments to go to his only daughter if he dies before the guarantee period ends, and if his daughter predeceases him, the payments should go to his favorite charity. What is not necessary to complete in the life annuity application? The answer and rationale: the item that is not necessary to complete is confirming Peter's identification. This is because Peter's identification would have already been confirmed when the original RRSP application was filed. Necessary requirements: naming a primary beneficiary, his daughter, providing his social insurance number, SIN, as it's a registered plan, naming a contingent beneficiary, his favorite charity, as he wants the money to go to them if the primary beneficiary, his daughter, predeceases him. Question 20. Earliest sources of retirement income. The scenario: Nicole is 60 years old and retiring in 2 months. To finance her retirement, she has a group RRSP, an individual RRSP, and a TFSA. Which of the following will be an available source of retirement income for Nicole in her first year of retirement, at age 60? The answer and rationale: the best answer is CPP, a RIF, and a TFSA. Nicole can start receiving income from all 3 sources at age 60. CPP, Canada Pension Plan payments can be started as early as age 60. RIF, Registered Retirement Income Fund, and RRSP must be converted to a RIF or an annuity By the end of the year, the owner turns 71. However, a RIF can be started anytime the individual chooses, regardless of age, e.g., at age 55 or 60. TFSA, tax-free savings account money can be withdrawn anytime. OAS, old age security, is not an option because it does not begin until age 65. Question 21. Retirement strategy for longevity and inflation. The scenario: Eric is 67. The answer and rationale: the most appropriate choice is 50% of his funds in a life annuity and 50% of his funds in a balanced fund. This two-bucket approach addresses both of Eric's main concerns. Life annuity, longevity: placing 50% in a life annuity provides a steady, guaranteed income for the rest of his life, ensuring he will not outlive his money and always have a base income for basic needs, shelter, food, and clothing. However, standard life annuity does not keep up with inflation. Balanced fund, inflation/growth: placing the other 50% in a balanced fund, which contains a mixture of GICs, bonds, and some equities, offers a safer way to achieve growth to keep up with the cost of living/inflation. A balanced fund is conservative but still provides potential for growth and is less volatile than an equity fund, which would be too high risk for a 67-year-old. Question 22. Old age security residency requirements. The scenario: Andrew immigrated to Canada 20 years ago and has just turned 65. He contributed to the CPP and maximized his RRSP contributions. What government benefit will Andrew be entitled to regarding old age security, OAS? The answer and rationale: Andrew will be entitled to a reduced old age security benefit based upon his residency of 20 years in Canada. OAS begins at age 65. The minimum residency requirement to qualify for OAS is 10 years in Canada after age 18. Andrew has lived in Canada for 20 years, so he meets this minimum. To receive the full OAS pension, a person must have been a resident of Canada for 40 years after age 18. Since Andrew has 20 years of residency, he will receive half, 20 divided by 40, of the full OAS amount. Important notes: OAS is residency-driven, not contribution-driven. You do not contribute to OAS. It is funded by general government revenue. Income from other registered accounts, like RRSPs, does not disqualify someone from receiving OAS. Question 23. Power of attorney and beneficiary designation. The scenario: Catherine gave her son, Robert, power of attorney, POA, for financial affairs. Robert is meeting with an agent to invest some of Catherine's money into a segregated fund. On the application, they named Catherine as the contract owner and annuitant, and Robert as the beneficiary. Robert signed the application on his mother's behalf. The insurance company returned the application for correction. Why did the insurance company return the application? The answer and rationale: the application was returned because Robert cannot name himself as the beneficiary, as it would be considered a conflict of interest. POA is a very powerful document. However, there are two key actions a POA for financial affairs typically cannot do on behalf of the client. 1. Name themselves as a beneficiary on an insurance contract. 2. Draw a will on behalf of the client. These actions are seen as a conflict of interest. Robert could have signed the application and may have been able to name himself as the annuitant, as he has control over the money, but he cannot name himself as the beneficiary. Question 24. Concluding client's risk tolerance. The scenario: Lisa has the following investments and assets: RIF, Registered Retirement Income Fund, with $600,000 invested in GICs, house worth $400,000, cottage worth $280,000, savings account of $50,000, outstanding mortgage of only $35,000. Based only on this information, what is the most reasonable conclusion about Lisa's financial situation? The answer and rationale: the most reasonable conclusion is that Lisa has a very low risk tolerance. All of Lisa's investments and assets indicate a strong preference for safety of capital. Her RIF is invested completely in GICs, which are a very safe, non-volatile fixed income security. She holds all the rest of her wealth in non-volatile physical assets and a savings account. She has a small mortgage and enough cash in her savings account to easily pay it off. She has no money in equities or any other high-risk investments. Therefore, the only concrete conclusion that can be drawn from the list of assets is that she is very conservative and dislikes risk. Other conclusions, like being age 71, having adequate savings, or not needing life insurance, cannot be drawn because they require more information about her age, lifestyle, and family needs. Question 25. Money laundering identification requirements. The scenario: Jessica, a new agent, is meeting with a client who wants to invest in a segregated fund contract. Jessica wants to know the client identification requirements under the Proceeds of Crime, Money Laundering, and Terrorist Financing Act. What must Jessica tell the client about the identification requirements if the client purchases a segregated fund? The answer and rationale: Jessica must tell the client that these requirements do not apply when the account is registered. Segregated funds held within a registered plan, like an RRSP, RIF, TFSA, etc., are considered exempt products. For exempt products, registered money, agents do not have to collect identification or report transactions of $10,000 or more to FinTrack, Financial Transactions and Reports Analysis Center of Canada. The requirement to report is only for non-registered money if the sum deposited is over $10,000. Question 26. DCPP retirement options for deferred income. The scenario: Jason is retiring next month at age 65. He has $400,000 accumulated in a defined contribution pension plan, DCPP, offered by his employer. Jason has sufficient savings and income from a new home business, so he does not need to use his retirement funds immediately. He wants to defer taking income from the DCPP until he turns 72. What is the best recommendation for Jason to manage his DCPP funds until he needs the income? The answer and rationale: the best recommendation is to transfer the funds to a LIRA, locked-in retirement account, on retirement, and then he can decide upon options by the end of the year he turns 71. The funds in the DCPP are locked-in money. Transferring the funds to a LIRA holds the locked-in money, allowing it to continue growing on a tax-deferred basis without forcing him to take an income immediately. Jason has until the end of the year he turns 71 to decide on his payout option, such as converting to a life annuity or a life income fund, LIF, and must start taking money out at that time. Other options are not correct. He cannot transfer the locked-in money to a RIF, because a RIF is not a locked-in vehicle. He cannot transfer the money to a LIF and defer income, as a LIF is a payout vehicle and income starts immediately, or within a month. He cannot purchase an immediate joint last survivor annuity with his wife, as registered money is restricted to single life only. Question 27. Philanthropic investment strategy. The scenario: Carol is a resident of British Columbia with $50,000 to invest. She wants to donate the investment to her favorite charitable organization upon her death. She desires substantial growth but is hesitant about a volatile fund because she wants to guarantee the charity receives at least the original $50,000. Finally, she wants to ensure the gift does not create additional cost, taxes/probate, to her estate. What is the best investment option for Carol to meet all three requirements? The answer and rationale: the best option is a segregated fund invested in an equity-based fund with a 100% death benefit guarantee, naming the charity as the beneficiary. This single strategy meets all three requirements. Substantial growth: equity fund investing in an equity-based fund gives the highest potential for return and growth, although it is more volatile. Minimum guarantee: 100% death benefit. The 100% death benefit guarantee ensures that the charity will receive no less than the original $50,000 invested, regardless of market performance. Minimize estate costs: name charity as beneficiary. By naming the charity as the beneficiary, the money bypasses the estate, avoiding probate fees, potential creditor claims, and estate taxation on the gain. Furthermore, the charitable contribution will generate a tax receipt that can be used by the estate to lower its tax liability. Question 28. Personal risk from financial advisor's approach. The scenario: Dr. Smith, a decorated professor earning $130,000 per year, is meeting with a new agent, Tom, to review her DCPP and RRSP, which are mostly invested in GICs and bond funds. She has no debt. Tom immediately discusses complex concepts like the advantages of RRSP tax deductions at her current marginal tax rate, RIF conversions, TFSA usefulness, MERs, and the higher standard deviation of balanced funds compared to her current investments. At the end of the meeting, Dr. Smith is frustrated and confused. What type of personal risk is most likely to impact Dr. Smith's financial plan if not addressed by Tom? The answer and rationale: the most likely personal risk impacting Dr. Smith is lack of financial literacy. Dr. Smith's confusion is a direct result of the agent overwhelming her with complex financial jargon and concepts. This suggests that her level of understanding of the marketplace, financial literacy, is very low. This lack of understanding, if not addressed by keeping the conversation simple and educating the client gradually, can lead to client inaction. She may be so confused that she delays or refuses to make necessary portfolio changes, such as moving from ultra-conservative GICs to a higher growth fund, that would benefit her long-term financial plan. Question 29. TFSA recontribution rules. The scenario: Ben has maximized his TFSA contribution. He has a total investment gain of $5,000. On November 15th, he withdrew $5,000 to pay for a family trip. In mid-December of the same year, he will receive a $15,000 work bonus and intends to use that money to maximize his TFSA contribution in the same calendar year. Assuming the maximum TFSA contribution for next calendar year is $5,500, which of the following statements is true? The answer and rationale: the true statement is, Ben can contribute $10,500 as early as January 1st of next calendar year. TFSA recontribution rule: any amount withdrawn from a TFSA in a given calendar year can only be recontributed in any year following the year of withdrawal. If Ben were to recontribute the $5,000 he withdrew in December of the same year, that recontribution would be considered an overcontribution because his contribution room for the current year is already maximized. Maximum contribution for next year, the total amount Ben can contribute on January 1st of the following year, is the sum of the new year's contribution room, $5,500. The amount withdrawn in the previous year, $5,000. $5,500, new room, plus $5,000, withdrawal room, equals $10,500. Question 30. Group Segregated Fund Guarantees. The scenario: Paul contributes to a group RRSP offered by his employer, who matches his contribution. He has 2 young children, ages 2 and 5. Paul chooses to invest in the group segregated fund offered by his employer. His reasoning is that the death benefit guarantee will protect his children from a market downturn, assuring them of a guaranteed death benefit, and he likes that there are no sales charges. Do you think Paul's reasoning regarding the death benefit guarantee is correct? The answer and rationale: no. Paul's reasoning is not correct because there is no death benefit guarantee offered on a group segregated fund. The maturity guarantee and death benefit guarantee are fundamental features that are only available on individual segregated fund policies, not on a group segregated fund contract. Paul is correct that group segregated funds typically offer benefits like lower fees and no sales charges. However, the cost of these benefits is the loss of the guaranteed features that an individual contract would have.